Okay, so we're diving deep today into something I think a lot of people are thinking about these days. It's the economy and inflation and how it all like really ties into, how we're doing as a society.
Yeah, absolutely. And the set of sources you brought together here is pretty impressive.
Yeah? Well, you helped me put it together, so
Right.
thanks for that.
We've got economic reports, we've got some historical analysis, and even some commentaries that really get to the heart of things.
Exactly.
The goal today is to try to zoom in on how this stuff really works, how monetary policy and especially inflation, how it all impacts individuals and societies in a real way.
Yeah, and reading through everything you sent over, I kept coming back to this one like central question. It just kept popping up.
Okay, listening.
Does inflating the money supply, I should say, does it actually make most of us poorer?
That is the million-dollar question, isn't it?
It is. So let's start by going way back and looking at some of the history.
Love it.
We have this quote from Alan Greenspan, and he doesn't mince words. He calls deficit spending a scheme for the confiscation of wealth, and he talks about gold as a protector of property rights.
Strong words for sure.
Yeah.
But this idea has been around for centuries, right? Think about Copernicus back in the 16th century.
Okay, yeah.
He was saying that while wars and plagues are the obvious dangers, the debasement of coinage, it's sneaky, it's insidious, and it like slowly weakens governments from the inside out.
Wow, it's almost like a hidden rot.
Exactly. And it makes you think about the whole idea of money and trust. Can we trust the value of our money? That seems to be a question that keeps coming up.
Doesn't it? So let's fast forward a bit to the 19th century in the U.S.
Okay.
And one of the figures you included, figure 2, it shows consumer prices pretty much stable for the whole century, even with like huge industrial growth and tons of people immigrating here.
Right. There wasn't the wild price swings that we've seen in more recent times.
Not at all.
It makes you wonder what changed, right?
For sure. So then things start to get interesting when we look at government spending and the role of the Federal Reserve.
Go on.
So figure 1, it shows this big jump in U.S. government spending right around the Great Depression.
Hmm.
And then figure 3, we see this parallel surge in federal debt.
And both of these are happening right as the Federal Reserve is getting established back in 1913.
Yeah, you can't help but see a connection there, can you?
A lot of people see a connection there for sure.
Okay, so let's bring this into the present with a modern example. Argentina under Javier Milei.
Oh, yeah.
This is fascinating. Figures 4 and 5 show that when they drastically cut government spending, their inflation rate dropped significantly, and their stock market really took off in 2024.
It's pretty recent, but it's a striking example of how fiscal policies can impact inflation and how the market reacts.
Yeah, companies like Telecom Argentina and Banco Macro, they saw some serious gains.
They did, but of course it's always a complex picture with lots of factors at play.
Absolutely. Okay, so we've got some historical background and a present-day case study, but let's get down to the nitty-gritty.
I'm with you.
How does inflation actually work, and what are the consequences?
All right, let's break it down.
Charles Hugh Smith, he describes inflation as the devaluation of money.
Makes sense?
Yeah, and he's really concerned about how it can like destabilize the whole social and political order.
It's a big claim,
It is.
but it's because when money loses its value, it undermines the very foundation of our economic system.
It's like the ground starts shifting under our feet.
Exactly. And Kevin Warsh, he puts it even more bluntly.
Let's hear it.
He says inflation arose from a government that spent too much and a central bank that printed too much.
It's kind of hard to argue with that.
It's a simple statement, but it captures a pretty widespread view of how inflation gets going.
Right, and then we have Henry Hazlitt. He lays out all these consequences of inflation, and they're not pretty.
What are some of those?
He talks about malinvestment, wealth redistribution, speculation, social unrest, and eventually even the collapse of society.
He really paints a bleak picture.
He does, and Milton Friedman, he adds to this by saying that the only way to truly cure inflation is through a temporary increase in unemployment and a slowdown in economic growth.
He's saying it's like a bitter pill to swallow, but in the long run, it's better than letting inflation run wild.
Exactly. He thinks the short-term pain of this cure is way less damaging than the long-term erosion caused by inflation.
It's interesting because Friedman was also pretty critical of the Federal Reserve's performance over the long haul.
Yeah, that is interesting, especially since they're supposed to be the ones keeping inflation in check.
Right, and then there's this quote from Lord Rees-Mogg that really captures the distrust some people have.
What's the quote?
He says, governments lie, bankers lie, even auditors sometimes lie, gold tells the truth.
Wow, that's pretty cynical.
It is, but it speaks to a deep skepticism about what we're being told about money and the economy.
And then Friedman, he has that great line that really sums it all up.
I'm all ears.
He says, only government can take perfectly good paper, cover it with perfectly good ink, and make the combination worthless.
It's such a striking image, and it really highlights the power that governments have over our money.
Yeah, so it seems like the consensus here is that inflation isn't just a minor annoyance, it's a potentially huge problem with serious consequences.
That's a fair assessment of the views we've been looking at.
Okay, so we've established that inflation is a big deal, but let's zoom in on how it actually affects people's lives, starting with wages and profits.
Okay, I'm ready.
We have these two figures, figures 8 and 9 that shows something interesting about U.S. corporate profit margins.
Tell me more.
From about 1950 to 1980, profit margins were generally declining, and this was happening while inflation and interest rates were going up.
So as prices rose and borrowing costs increased, businesses saw their profits shrink.
Right then, after 1981, inflation and interest rates started coming down, and guess what happened?
Did profits start to rebound?
They did. Profit margins started this long, steady climb upwards.
It suggests that managing inflation and keeping interest rates in check can be crucial for businesses to thrive.
Exactly. Now, let's switch gears and talk about wages.
Yeah.
Constantino Bresciani-Tironi's work, The Economics of Inflation in Figure 10, they illustrate this crucial point.
Go on.
When the cost of living keeps going up faster than people's wages, their real wages, what they can actually buy with their money, it goes down.
It's like running on a treadmill. You're working hard, but you're not really getting ahead.
Exactly. And then we have this really stark historical example, the German miners in the early 1920s.
What happened to them?
Their real wages absolutely plummeted during that period of hyperinflation.
Ouch. So all those price increases were wiping out their purchasing power.
Yeah, and sadly, this isn't just ancient history. The information you provided shows that real wages are actually declining right now for something like 70% of the population in Western democracies.
Really?
Yeah, and John Williams's shadow staff CPI figure for December 2024 puts the U.S. inflation rate much higher than the official figures at 10.95%.
So even if the official numbers say one thing, the ShadowStats CPI, which uses older calculation method, suggests that the pressure on people's buying power is much more intense.
Exactly, and it really makes you think about what happened to those German miners back then. Their buying power was destroyed, and it seems like we might be seeing echoes of that today with so many people experiencing declining real wages.
It's definitely a parallel worth paying attention to.
For sure. And Peter Schiff, he asks this very pointed question.
What's that?
If we have such a strong economy, why are so many Americans struggling?
It's a question a lot of people are asking.
It is, and then we look at these figures 11 and 12, and they really paint a clear picture of the struggles people are facing.
What do they show?
Credit card defaults have jumped by 50% year over year, and the bottom third of U.S. consumers have a savings rate of 0%.
That's alarming.
It is, and to make matters worse, credit card interest rates have almost doubled since 2016.
So people are falling deeper into debt just to make ends meet.
Exactly, and this all contributes to the growing gap between the rich and the poor. Wealthy people don't usually rely on high-interest credit cards in the same way.
Right, and Bresciani-Tironi, when he was studying the German hyperinflation, he noticed that the people who profited the most from it weren't the ones producing things.
Who were they then?
They were the speculators, the people who were betting on rising prices.
So they were getting rich while everyone else was struggling to keep up.
That's the idea, and he even goes so far as to say that these new economic elites, they rose from the increase in the poverty of the people.
Wow, that's a sobering thought.
It is. And Figure 13 shows how even German state officials, people with supposedly secure jobs, saw their real salaries plummet during that hyperinflation.
It's like no one was immune.
Exactly, and you can't help but see some parallels to what's happening today.
How so?
We've seen these huge gains in things like financial assets and cryptocurrencies, while a big chunk of the population in places like the U.S. is living paycheck to paycheck.
Yeah, it's like this growing divide between those who are benefiting from the current system and those who are being left behind.
And PGIM Fixed Income, they have this analysis in Figure 14 that shows how earnings are shifting from labor to capital.
Meaning?
Less money is going to the people who work, and more is going to those who own assets.
Right, and they point to things like technology, globalization, and the skills gap as drivers of this trend, which all contribute to this growing economic inequality.
It's a complex issue with lots of moving parts.
Definitely. So it seems like inflation, especially when it's combined with certain economic and monetary policies, can make existing inequalities even worse and leave a lot of people in a really precarious financial situation.
That's a key takeaway from what we've been looking at.
Okay, so let's move on to asset bubbles and all the volatility we're seeing in the markets.
Buckle up.
The materials mention this expectation for declining asset prices, with potential peaks already happening in bonds, commercial real estate, and even residential property.
And they use Austin as an example of that in Figure 15.
Yeah, so the idea is that the good times might be over for certain asset classes.
And Bresciani-Tironi, when he was observing all the chaos of monetary inflation, he realized that it creates this really unstable environment where economic conditions can change so quickly.
Yeah, it's like the ground is constantly shifting.
Exactly, and this can impact different industries and assets in unpredictable ways.
And he saw firsthand how devastating it was for small investors and even some large capitalists during the German hyperinflation.
It's a reminder that even those who think they're playing it safe can get wiped out.
And while monetary inflation can initially push asset prices higher, the data you've provided shows that it's not a sure thing, and some assets can take a hit really fast.
Right, we're seeing that now with bonds, and real estate figure 16 even uses the market for Rolex watches as an example of how collectibles might be declining in value.
Wow, so even luxury items aren't immune.
Yep, and then you add in all the geopolitical tensions we're seeing, like the war in Ukraine and the situation in the Middle East, and things get even more volatile.
It's like adding fuel to the fire.
Exactly. Simon Hunt, he predicts that we could see extreme volatility in the markets all the way into 2028. And he even suggests that regional conflicts could escalate into something much bigger.
That's scary stuff.
It is. And then there's the potential for a U.S.-Israel strike against Iran and the impact that would have on global markets. That's another big unknown.
So much uncertainty.
Yeah, and this uncertainty makes it even harder for investors to know where to put that money.
Absolutely. Okay, so all this volatility and uncertainty, what does it mean for the average investor?
That's a great question.
Bresciani Tironi, he observed that during the German hyperinflation, the decline in stock prices when measured in gold basically wiped out a lot of small investors and speculators.
And he also talks about these really aggressive confiscation policies enacted by big shareholders, which basically screwed over the smaller ones.
That's just brutal.
It was, and while we might not see those exact tactics being used today, the risks for small investors in an inflationary environment are still very real.
Yeah, it's like the little guy always seems to get squeezed.
And JP Morgan, they have this data in figure 17 that shows how retail investors as a group really underperformed the S&P 500 in 2024.
So they were losing out while the big institutional investors were doing okay?
That's the idea. And then figure 18 illustrates how these financial bubbles we've been talking about, they tend to concentrate wealth in just a few really large companies.
And those companies might not always do so well in the long run.
Exactly. So if small investors buy into these high-flying stocks at the wrong time, they could end up losing a lot of money.
Ouch. Okay, so let's talk about the US dollar and how it stacks up against other currencies.
Right?
The sources you provided, they acknowledge that the dollar is still strong compared to the German mark during hyperinflation.
Which is a fair point.
But then they point out that since 1970, pretty much all currencies have lost a ton of value against gold.
It's a reminder that even the dollar, while it might seem strong compared to other paper currencies, it's still losing purchasing power over the long haul.
Yeah, and they suggest that we might see the dollar weaken against other currencies as global capital flows start to shift. Figure 19 tracks the US dollar index, so we can keep an eye on that.
It's important to remember that conditions can change very quickly, especially during times of inflation.
And this section wraps up by talking about why it might make sense to hold precious metals, both physical gold and silver, as well as shares in mining companies. Figure 20 has a whole list of those.
Okay?
And they also suggest that European stocks might actually outperform US stocks in 2025.
Interesting.
They point to figures 21 and 22 for that, and they think value stocks might do better than growth stocks, figure 23, and that emerging markets could be a good bet, figure 24.
There are a lot of moving pieces influencing these predictions. Potential political changes in Europe, lower valuations of European stocks compared to U.S. stocks, and historically, both value stocks and emerging markets have done well when the dollar weakens and global growth slows down.
Right, and they highlight this recent uptick in the U.S. money supply growth, figure 25, which could push asset prices higher, especially for real goods like food, and potentially weaken the dollar.
It all adds up to a potentially bumpy ride for the global economy and financial markets.
Okay, finally, let's talk about this essay by Fernando Di Pino Calvo Sotelo about the common good.
All right.
He defines it as all the social conditions that are necessary for people to fully develop as individuals.
It's a really interesting way to frame the conversation. He's looking beyond just economic numbers and thinking about what it takes for people to truly flourish.
Yeah, and he makes it clear what he doesn't mean by the common good.
Tell me more.
He says it's not just the sum of individual benefits. It's not about the state owning everything. It's not collectivism, and it's not just about redistributing wealth.
Okay, so what is it then?
He says it's about creating the right kind of society, one that protects things like life and the family unit basic freedoms, like freedom of thought, speech, and religion, a society that encourages economic progress through free markets and private property, and one that values truth, honesty, and peace.
It's like a blueprint for a healthy and thriving society.
Exactly, and he suggests that Western societies today might not be living up to these ideals.
Which makes you think about the broader societal implications of all these economic trends we've been talking about. If inflation and these other policies are actually hurting people economically, how does that affect these fundamental elements of the common good that he's outlining?
It's a deep question.
It is, and his essay gives us a valuable framework for assessing the overall health of a society. It goes beyond just looking at GDP or inflation. It asks whether the current conditions are actually helping people reach their full potential.
So to wrap things up, it seems like all these sources together, they make a pretty strong case that there's a link between monetary inflation, government policies, and the potential for a lot of people to become poorer.
We've looked at historical examples, analogies of declining real wages, rising debt levels, growing inequality, and all the volatility in asset markets that can really hurt smaller investors.
And while what we're seeing now isn't exactly the same as the hyperinflationary periods of the past, the basic principles and the potential negative consequences are still relevant.
Those historical lessons are definitely worth paying attention to.
So here's a final thought, something to really ponder, inspired by Fernando Dupino Calosatello's essay. Given all these economic trends we've discussed, do you think the current conditions in your own community and in the world are really helping people thrive and reach their full potential? What's one specific aspect of this that you might want to think about more deeply or even try to change?
That's a great question, and one that I think we all need to be asking ourselves.
Absolutely. Thanks for joining us for this deep dive into a really important topic, and we encourage you to keep exploring these ideas and the sources we've shared today.
It's been a pleasure diving deep with you.
Same here.